Hello everyone, or let me say hello investors. Now today I want to ask you a question. Are you an aggressive investor, or are you a balanced investor, or are you a conservative investor? You see, this particular question, you must answer it very well, like truthfully, before you invest in stock market. So once again, I'm Timile Shonuga Virtuous One, and I'm a financial advisor at Yes Insurance Group. So I deal with anything finance, anything money. You can come to me. I'm your go-to-go girl. Having met some prospects in my line of business for a couple of months, I discovered that most investors want stability, and at the same time they want growth. At least the most of the people that I've come across, they want stability and growth. They want the two at the same time. So when you offer them low percentage or low interest rates, they're like, if I put my money in business, do you know how much I will earn? If I will earn that interest that you are offering me at the end of 1 or 2 months, you are not telling me that you want to offer me that kind of interest for 1 year. That's why I'm asking you that question. That are you an aggressive investor, a balanced investor, or a conservative investor? Most people that I've come across actually fall in balanced investor. Conservative investing is for people that have made wealth. They have made the wealth. They just want to conserve the money. But if you are still making money, it's better you are a balanced investor or aggressive investor if you can take risk. Now, who are the aggressive investors? They are the young and high risk. Hey, these ones can take a risk. They want fast growth. They don't want it to grow steadily. They are not looking for 20% per year, 30% per year. They are looking for something that is very high, interest rate that is very high. So these ones, how they can diversify their portfolio is putting 70% in growth and penny stock. Their total investment, they will put a whole 70% in growth and penny stock. And I believe we know what growth and penny stock is by now. These are the kind of growth that are stocks that are very risky, but if they are giving you returns, most times they give high returns. And they put their 20% in core stocks and 10% in dividend paying stocks. Even me, I don't really consider dividend paying stocks like that, because if I can earn a high interest on a normal day, why should I wait for dividends before getting my money or getting my profits? You understand? So, and another one here is a balanced investor. The balanced investor, these ones want growth and they want safety at the same time. Like those prospects that I just talked to you about earlier, they want growth and they want safety at the same time. This kind of people put 50% in customers, the ones that they know they can be rest assured about their money will not just go down all of a sudden. They put 30% in growth and penny stocks, just 30% in growth and penny stocks, and 20% in dividend paying stocks. I think this is fair enough. I think this is the group that even me, I find myself. I'm not sure I'm an aggressive investor yet. I might consider being one in the nearest future. Anyways, now the third one on my list is conservative investor. This kind of people, most of them are near retirement. They want to protect their capital and earn at the same time. They are not ready to take risk. You understand? So they put 60% of their money in core stocks, 30% in dividend stocks, 10% in penny, just 10. In fact, they might not even take penny at all, and 10% in growth stock. Now, which group do you fall? Understand that before you start picking your stock. And the reason why we always advise this is because if you think you're an aggressive or you are an aggressive investor, and you are not one, and you put your money in penny stock, growth stock, larger percentage of your money in it, and at the end of the day, market just fall, it is not yielding, so that you don't go and develop IBP. So you have to understand if you are one before you take that risk. Now, let's go to different types of risk in investment. There are different types of risk. Let me tell you, risk is normal. In fact, I think there are some age, there's this season of life that one must actually take some risk. If you are not ready to take some risk, you are not ready to grow. If you are 25 to 35 and you are not ready to take any risk, even if small, I'm sorry, you are not ready for growth yet. So risk is normal, but ignorance is dangerous. Just understand the risk level before you actually go into it. And the first risk on my list here is market risk. When it comes to stock markets, the entire market can fall due to economic risk. Market can enter bull level today, and in the twinkling of an eye, it just go bearish, and we are wondering like what happened. Markets happened, economic happened. Then another risk here is company risk. There can be failure due to poor leadership, debt, scandals, weak strategy, and all of that. This is common with some companies that are just developing, some companies that fall under growth and penny stocks. They can experience failure, and that's why you can see that your money can go down all of a sudden, maybe due to poor leadership or debt. So the solution to this is research management. Do your research very well. Check their financial health. Check how they have been running the system in markets before you invest your money, so that you can manage your risk level. Then the third risk is liquidity risk. Hey, I cannot stop emphasizing this risk. When you cannot easily sell your shares, you know that trouble is knocking. I buy share with my money and I cannot sell the share when I need to share. Still going to talk about analysis. We are going to have somebody on board to talk to us about fundamental analysis and some market terms, technical terms. Now, it is okay when you buy shares, but there are some times that you know that after doing your analysis, you need to sell these shares now. Imagine you cannot sell the share. So you need to put this risk into consideration. It is common with small companies and penny stock. I think I've explained that in my previous video. And the fourth on my list is emotional risk. Emotion of fear, greed, emotion of missing out. I call this FOMO. So please be careful. The fact that they are shouting MTN on TikTok today, Seplat on YouTube tomorrow, Dangote on this thing please don't just go emotionally. Understand the business, because you may buy high and sell low at the end of the day. Imagine when people are buying stock when it's 14 naira and the stock rise to 17 naira. Those people already have, when they sell their own, they are selling on maybe 30% at that particular time. You now buying it when it is 70%, all of a sudden you just drop to 40%. How would you feel? So please manage this risk as much as possible. Then the last one on my list is time risk. Don't invest the money you need too soon. Be patient. Give the market some decorum. Be patient. The money that you need in the next 1 week, you are investing it today. How now? Please never invest money that you need the next month, the next week. Be patient with your money. Allow your money to grow. At least invest for the period of at least 3 months, 6 months. In fact, sometimes 1 year. As long as you diversify your portfolio properly. Now let's talk about proper defense strategy. Invest for long haul. That's the number one. If invest fixed amount consistently. Let's say you want to be investing 100,000 naira monthly. You can invest low. You can even decide to invest 5,000 naira. So let's just say you want to invest 100,000 or even 5,000 naira monthly. So just invest a fixed amount of money consistently, because that reduces the risk of bad timing. The third defense strategy that I have here is rebalancing. Adjust your portfolio periodically. The fact that you pick some stocks at the beginning of your investment doesn't mean that the same stock must be retained till the end of your investment period. No, you can adjust your portfolio. You can adjust it for the period at the end of every 6 months. Because the one that is good the first 6 months might not be the one that will be good in the market in the next 6 months. So adjust your portfolio periodically. If your growth stocks become too large, sell some and buy core and dividend stock. I've heard of a stock that rise by 400% before. Imagine you invest in that kind of stock and it rises by 400%, and you are still looking at the portfolio like this. You are still watching it, hoping that it will rise again. What else do you want? That means if you invest like 1 million naira in that kind of stock, you are getting like 5 million naira return. Sorry, after 1 million naira reach 5, what else are you looking for? What else are you looking for? It is better to sell that and invest in core stocks that still have stability, so that you can preserve your money and you won't regret timing issue. The last defense strategy I have here is review regularly, not obsessively. Don't be so obsessed with it that you are checking it all the time, every minute. No, review regularly, not obsessively. Now, what are the common traps to avoid? The common traps to avoid: chasing hype stock. Avoid being trapped in that. The fact that a stock is hyped doesn't mean that it is good, and doesn't mean that it is bad. Avoid that trap as much as possible. Then the next one on my list is ignoring transaction fees and taxes. When you buy stocks, there are some taxes, transaction fees that they remove from it. Don't ignore it. Imagine you buy a stock of 10,000 naira and the tax is 7,000 naira. Even if that one rise by 10%, your return will not be genuine at the end of the day, because the tax that has been removed has already affected the money. So you have to check all those things before you buy the share. Another one is panicking during market dips. Don't panic. Markets can go down. Even the normal biscuits, rice that we buy, sometimes markets can experience some panic attacks. So don't panic. Don't panic too much. Calm down. It's not every share that goes low that you quickly sell because it goes low. It can go low and still rise in a limited time. So don't panic. And please, the last one on my list is do not overtrade. Do not overtrade. This is not a gambling business. It's an investment strategy. And on this note, I'll be ending this session. Thank you for following through. Don't forget that you can drop your comments, you can drop your suggestion, or any other thing that you have in mind. I celebrate you and see you next time.